Hey everyone, this is Mike Bond with Hard Money Mike. Today we're going to go over a couple ways of showing what a good deal is and a video or two on what a bad deal looks like from a lender's perspective, because if a lender likes it, you should like it, and if a lender doesn't like it, it's another indicator that maybe it's just not a great deal. So let's start from the beginning. What does a good deal look like for a lender and for yourself? We're going to start with one of the most important things that all lenders and all investors look at, and that is profit. What does that profit look like on each deal? Each deal should have a minimum of 10%, but at least a target of 15% of the ARV, the sale price, the after repair value. So if you're looking at a $200,000 ARV, your sales price, your after repair value, you should be looking at somewhere around $30K, 15% of $200,000 for your profits. And why is that also important to lenders? Because if you're not going to make a profit, you're not showing a profit or a large enough profit, what's in it to keep you going? What's in it to keep you in this game? Lenders want to make sure that you're making a profit, that you see a profit in it to start out. So somewhere between the 10 and 15%, 15% because if you're going to do that 2 times, you're going to make 60. And if you're going to do that 3 times, you're going to make 90K in a year. Compare that to even if you go down to 10%, that's 20,000, 40,000, and 60,000. You can see the difference. The profit is what makes this investing worth it for you. Creating profits, creating generational wealth is what investing is all about. Profits are the first phase of this and making sure it's a good deal, because you have to understand what lenders are looking for, what they want to make sure you see in a deal. So we went through the profits. What else is included that you need to understand when you're looking at a good deal? Part of that is also what's the cost going to be to sell the property. And typically you're looking at somewhere between 4 and 6% to sell the property. Part of that is real estate costs. So that could be somewhere between 2.8 and 6% itself. But hopefully you're working with someone, you got a good deal, and they're going to give you a break. But there's also closing costs. There may be some concessions you have to give to the buyer. Maybe you have to fix a few other things up. So not only do you have profits here, and this is all going to go into an equation you've probably seen 100 times, seeing where the profits come from. 15% here selling, and then the other part, when you're looking at your numbers and what makes sense, when you're looking at numbers for lenders, is your cost of funds. So that's somewhere between 5 and 6%. So the cost of money, your loan, your leverage, whatever you call that, you got to make sure you put all of these numbers in before you start to make sure, and your lender wants to see these too, because what this looks like is somewhere between 27%, the very low price is 19%. So what do these numbers represent? That represents on the ARV how much you or the lender is not going to fund, because that's going to come out at the end. Your profits are going to be paid out when you close. Your real estate cost and your discounts are going to also be paid out at close. The cost of funds, depends if you roll them in or if you're paying them, this is going to be a part of the deal too. So like we said before, these numbers represent what the lenders are not going to give you as far as your profits, the sale cost, and your money cost. That's where we come up with when everyone talks about the 70 to 75% of the loan to ARV. This is where lenders want to be when they're lending you the money. So when we're talking about that $200,000 ARV, the sell of a property for $200,000, lenders are going to give you somewhere between 70 and 75%. And the reason is because they want to make sure you have counted for all these other numbers. You're going to make sure you have a profit, what it's going to cost to sell, and their cost of money. These are all numbers that are not financed into the loan, that have to either come out of the sale or out of your pocket. When you're starting out a loan, when you're starting to look for a lender, what makes a good loan and what they're looking to keep the loan at 75% because they understand these numbers are coming out at the end, or they have to be contributed by you as the borrower. Now from a lender, if you're coming to us and we know you understand these different numbers here, that it's going to at least be 15% if you're a quality investor looking to keep profits. You're going to look at what it's going to cost to sell it, because that's something that's going to come out of the closing and what it's going to be for your money. All of this adds up to what the lender is not going to give you. And as long as you understand that coming into the lending game, talking to a lender, you're going to be right in line with what they want to give you. Hard money would probably go a little bit higher depending on the deal, and even finance a little bit more than your traditional out there private lenders and banks. But we're going to stick somewhere between the 70 and 75% of the ARV. Anything in that or below is what we consider a good deal. Of course, the lower, the better the deal you get. If you're all in at 65 or 60%, all that means is this number is going up. Your profits are going up. We love to see that as a lender. You love to see that as a borrower. Now in the next couple of videos, we're going to take this and expand. We're going to go over actually putting in what does the purchase price, the rehab, all of those numbers will look like to get to that what we call a good deal. And then also some real live examples of what we look at and don't feel is a good deal, because we know if you're not going to profit, if you're not going to make money, we don't think it's a good deal and we don't want to lend you the money. Now we understand if you're not going to make that profit, you're not going to be happy, you're not going to be a satisfied client, and you're not going to make any money. So why should we lend you the money when it's just going to be a heartache for everyone? We want to make sure investors are making money so we can lend more money on more and more deals. The higher the profits, the more engaged, the more you're bought into the deal. A good deal from a lender's perspective is seeing a good profit for the borrower. Real estate is an investing game. It's a numbers game. If you have some numbers you want to run by, just email me at mike@hardmoneymike. And also check out our website, hardmoneymike.com. We've got some great tools there, from a loan cost optimizer, DSCR calculator, all free tools to make you a better investor. And we'll catch you on the next video.